Hello, my friends. I hope this video finds you and your families well. It's been quite a roller coaster ride over the last couple months here in South Florida with the spikes of the pandemic. But again, I hope that all of you are well. A couple months ago, I provided an update, a market update on the housing market and on commercial real estate. And because we've reached the midpoint of the year, so to speak, I wanted to give you a mid-year review of where the housing market is and where the commercial real estate market is in our industry. I'm going to start by sharing the screen and for this presentation here. I hope you can all see it. By the way, this presentation and others, I'm going to put a link to it below, so you don't have to worry about not having this information. It'll be readily available. Therefore, I'm not going to go over every single detail, but there are a few things that I do want to point out to you. So the first thing I want to say is I want to give thanks and credit to the Miami Association of Realtors, the Miami Commercial Division of Miami Realtor Association, the National Association of Realtors Commercial Division. And I want to point out and give special thanks to a couple of individuals, Ron Sheffield from Berkshire Hathaway WM Realty, and Mr. Anthony Graziano from Integra Realty Resources. They were kind enough to provide an update for all Miami commercial and Miami residential real estate members on a South Florida market update. I've used some of the same slides here because I think they're poignant and they really convey a really clear picture of where the market is. And I just wanted to share it with you for your benefit. So if you remember, a couple months ago, there was the feeling among economists that the the residential real estate was going to lead the recovery, that real estate as a whole was going to lead the recovery. And the reason for that is because we've had a shortage of inventory. Then we had interest rates go low. We had pent-up demand, and we had people that were pulling the properties off the market. So there's a couple of things that I want to explain here. What we're going to see in the first few slides here is about Miami-Dade County. We're going to look at single-family homes in different price points, and we're also going to look at condo market because we're seeing that there is a dichotomy between the two markets. You know, the markets are very different, whether it's a single-family home or a condominium. So one of the things that I want you to point out here is pending sales. These are single-family homes over $1 million in Miami-Dade County. You see that there was a low in April, and ever since then, we've seen an increase in the amount of pending sales. Now, this number, as you're going to see, is going to skyrocket for properties that are below $1 million. So if you look at the next slide, single-family homes under $1 million, look at this huge number in here. Are from a low in April of 722 pending sales. We've had two back-to-back months of 1,300 and 1,685, which is a record of pending sales. This again came out of the fact that we've had, and I'm going to show it to you in the other slides, we've had a significant reduction in properties that are on the market. We've had pent-up demand for specifically single-family homes, and we have low interest rates, and we have a lot of people that have the ability to do it, and sellers that those that have entered the market have really benefited from the demand on the market, because we've had a very short amount of days on market for a lot of these properties. So let's look at this slide. I just love the way this is presented. This is basically single-family homes in Miami-Dade County that are $300,000 or under. If you're looking for a house in Miami-Dade County for $300,000 or less, you know how difficult it is to find something like that. And if you can see from July of last year to July of this year, this is all from July 18th of 2019 through 2020, we're seeing a 43% reduction in the number of houses on the market. You know, last year in July, we had 682 properties on the market that were $300,000 or less. Now we're down to 387. And our months of supply for this kind of product is 1.8 months. So if you look at this indicator below here, I wanted to point it out. It's very important. We feel that 6 to 9 months worth of inventory of the market is what we call a balanced market, or what Ron Sheffield here calls optimum supply. Anything below 6 months is a seller's market. Anything above 9 months is a buyer's market. So when we're looking in here, 1.8 months of inventory, I mean, it is a very hot seller's market for this price. We see the same thing, a little bit of a different story when it comes to condominiums, But believe it or not, the condos that are $300,000 or less are faring better than any other price points in condominiums, as you will see in the slides. We've had only a 4.5% reduction in the number of condos in the MLS year over year, and we've had a 34% increase of supply. Some of those condominiums have entered the market. I think perhaps there is some truth to what people are saying about their, there's a little wear and tear of having to spend 2-3 months in a condominium, and people that were already had built up a lot of equity, they are in the market to sell a condominium and maybe buy a home. And so we're seeing, I think, a little bit of that transition from the condo market to the single family market. Now, this is really the one that I wanted to show you, because this is really where the most of the sales are in Dade County. Single family homes that are $300,000 to just under $1 million. They make up 69% of all the sales in the MLS. But look at what's happening year over year. We've had a 33% reduction in inventory. And we've had, in the last 200 days, this number here is 200 days. It's from January 1st to July 18th. We've had a 28.9% reduction in inventory. We have a market that has only 3.7 months worth of inventory for that range of $300,000 to $1 million. And we've seen the median price go up. Now, please keep in mind, this changes from market to market, and it's very specific to the property, location, all of those items that are important when you're evaluating. That's why it's always good to have a comparative market analysis by a real estate broker, so that you get a real understanding of where the value is. But we are definitely in a seller's market. Now, condominiums are different. In that same price range, condominiums in Dade County have gone down inventory-wise only 8.9%, but we've actually seen an increase of supply. Again, we're seeing that dichotomy. There's an increase of supply of condos. There's a decrease of supply of single-family homes. And if you look at the days on at the months of supply of market that are available at that price range in Dade County, is 23.4 months. Now, that doesn't mean that that's county-wide. So what happens is that in that price range, depending on the area, you might only have 8 or 9 months worth of inventory, so of supply. So this is really county-wide. Some areas are more heavily have a higher supply than others. So that's why, again, it's important to get a real clear understanding, somebody who's going to evaluate your property. The next things that I'm going to show you is basically single family homes in the $1 to $1.2 million range. Again, we've had a reduction of supply. These properties usually take a little longer to sell. There is movement, however, and prices have only gone down so slightly. Condos, even though we've had, again, an increase of supply and inventory in this price range, we've actually seen a little bit of an improvement on the median price. When you're looking at single family homes between $2 and $3 million, in here you're seeing, again, the prices have remained the same. We've had a lower supply of inventory. We've had 22.4 months worth of supply of inventory in the market. However, again, this is going to vary dramatically from area to area. So if you are in a single family home that is $2.7 million in Coral Gables, that number is going to be significantly different than if you're buying in other parts of the county. So again, it's very important that one of the things that we're seeing is not only are the prices staying the same or a little bit higher, but the properties that are well staged, properly marketed, that enter the market the right way, are getting a lot of attention and are moving. So the other stuff that you see here is, again, condominiums at this price range. We have over a 2 years worth of months of inventory. So again, it's a different market. But I provided all this information for you. Feel free to review, and feel free to let me know if you have any other questions. The other thing I'm providing for you is these two reports. One is a commercial market insight, which is really about the large commercial, right? And the one on the right here is the commercial real estate trends and outlook for July 2020. This is actually for commercial properties that are at or below $2.5 million. So this is for small commercial. There's a lot of great information and a lot of great insight. And I just kind of wanted to go over, the overview of what we're seeing. The commercial overview, as we see, no surprises here, right? The hotel and retail properties are taking the heaviest beating. We're seeing that multifamily and industrial are performing relatively well, and the office sector is somewhere in the middle of the park. Improving job markets is kind of the silver lining of the economic horizon. However, I know that there's concern of people by the resurgence of coronavirus cases that would be casting a shadow on job recovery and the reopening of the economy. However, today is Thursday, August 6th, and the news today were that I think the weekly jobless claims came in at 1.18 million. They were expected to be 1.48 million, so that's significantly better. The other one item is today was also announced that for the third week in a row, the state of Florida has had a reduction in the in the reduction in the weekly claims for unemployment. All right, investors are seeking a higher risk premium, right? Because in some cases just because they feel that because they're buying at a time of so much uncertainty, and we are seeing that there is an increase in the risk spread between the cap rate and the 10-year treasuries. However, we're seeing the lowest risk spread among multifamily properties and industrial property. So if you own one of those two, asset classes, this is the time to really evaluate, or if you're going to purchase that type of asset. Multifamily overview: you have strong demand, collections risks remain elevated. Rents rose at a slower pace, but they have also outpaced inflation. There is a higher risk to rental income in lower class apartments. And there's concerns about renters' ability to pay, and their ability to pay. Does it come from the assistance that they're getting from unemployment, or how fast they can get back to work? However, there is some, really positive news here. There's a lot of positive news here in multifamily, but the NA REIT reported that REITs received 97.5% of the typical rent in June. That's up from 89.9% in April. On the industrial sector, in strongest asset class, because we have that demand for e-commerce, that's likely to be the catalyst for industrial space recovery. Sales on non-store retailers have grown almost at a 10% pace every month, including once a lot of these stores the brick and mortar stores started to reopen. We still saw an increase in sales for non-store retailers. Manufacturing demand could increase because of disruption of the supply chain. The smaller warehouses and flex space could see an increase in vacancy because of the slowdown of the economy, because that impacts smaller businesses first, and smaller businesses are the ones that mostly occupy these spaces. Although for a lot of businesses that are, that have seen an increase in the amount of revenue and in work, there has been an incredible amount of demand for this product. Rental rates are likely to stay stable. Now, this you're going to find the same for office as well, and you're going to see it next. But vacancy rates could see some upward pressure, and the rate of unemployment, again, is something to watch for because it could impact demand. And of course, the impact is going to vary market to market. The office sector, as I mentioned, we already had a trend of moving towards suburban offices. It started in 2017. This can actually gather steam as a result of social distancing. We do see a reduction in the amount of office sales, but offices are getting leased, space is getting expanded. And, we understand that expanded use of remote office and virtual meetings are going to last beyond the current crisis. That's not going to go away. However, every survey tells us that collaborative environments are preferred over individual and remote environments. I know a lot of people are missing that component because as much as we are able to connect through these virtual meetings, there is there is something that is lacking. So we know that that's not going to go away. However, there is great uncertainty for co-working platforms because of high worker density and shared amenities. Again, as in the industrial market, the rates are, rental rates are likely to remain stable. Vacancy rates are likely to see a little bit of an upward pressure, and we have to watch out for the unemployment, and it is going to vary from market to market. Retail, slow recovery is likely to continue. This is going to be a process. According to Dage Property Solutions, almost half of retail rent was not paid in April and May. However, that number has increased. If you look at June, again, NA REIT indicated that typical rent received from retail rents, both shops and centers, for the month of June was 79.4% as opposed to 70.6% the prior month. Retail sales are growing, but they're not at the level of pre-coronavirus yet. We're likely to see store closures increase over the next 2 years. What that's going to do is it's going to be an increase in vacancy rates. Rental rates are likely to decline. However, there are a couple of things that are very important here. Number one, it's going to be important for anybody who is acquiring or managing a retail project to reposition and to look for creative uses for those vacant spaces. So I'm really eager to find out how a lot of these owners are going to readapt and reuse the property. The second thing is that the grocery anchored centers, the ones that have the Publixes, that have the Albertsons, that have, the Winn-Dixies, are going, and the single tenant, net lease properties are expected to perform well. So again, there is variety when it comes to all of this information. Lastly, what I like to say, as I always do, is, there's nothing better than to have a hyper local review of your property and of your acquisition goals. So once again, the link is below. I invite you to book a chat with me. We can do a Zoom call, and we can, get you on your way if you want to review the valuation of your property for now or in the future, or if you want to look at, targets for acquisition for your investment, or whether you're buying or selling a single family home. We're a full service brokerage. We have great people that have the priorities in the right place. So once again, I just want to say thank you for spending the time to listen to this. I hope this was helpful. Feel free to reach out to me. I'm happy to help in any way that I can, and provide you with any clarity or information that you need. Take very good care of yourselves. All the best to you. Take care.